Hey everyone, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about a dividend growth high quality stock that's undervalued at current price with a nice dividend yield over 3%, close to 3.5%, and is increasing their dividends, recently increased the dividends over 10%, and announced a $15 billion share buyback, which is going to help grow earnings throughout the years. This dividend stock I've covered in my channel before, so if you're new to the channel, make sure to hit that subscribe button, and if you enjoy the video, hit that like button. So we're gonna cover the past video that I created. We're gonna look at the fundamentals of this company. We're also gonna look at the technical analysis. We're gonna determine the support and resistance levels of the stock and see if it's a good buying opportunity now and where can we buy or even possibly sell more shares of it. So if you're new to the channel, make sure you hit that subscribe button and let's get started. So you see here in December 10th, 2020, I made a video on 3 different stocks for high total returns, and Bristol Myers Squibb company was one of those in that 3 dividend stocks. Make sure to check out that video as well. But first, you see at that time the price was going for $60.23. I had a buy rating, obviously, and I really liked this company. And actually, I bought more shares here a few days ago, on the 13th, 5-6 days ago. And you can see here, I bought 30 shares, around $1,700 worth of shares at $58.73. This is why, even though I say I make videos of companies that I like, I actually invest in them as well. So that's why I post those videos, is that I like them. But anyway, this company just announced a dividend increase of 10% to 54 cents per quarter, and a $50 million buyback, share buyback, which also what that does is help increase earnings per share when the company buys back their shares. And because the company is so undervalued, I think this is tremendous, because this is going to help buy more shares at a cheaper price. So you can see a 10.2% increase versus the prior dividend, and right now they have a yield during this release at 3.83, but now it's at 3.5 because price has gone higher because of that. So you can see here it's at $61.56, and I bought it at $58. So I'm up about $3, $4 or so since I got it. And this stock still has potential to run higher. So you can see at this time it was at $60 when I made this video. And if we look at the technical analysis on Bristol Myers Squibb, you can see here, this is the monthly chart and this is the weekly chart. For long-term investing, this is the 2 chart you want to look at, the monthly as well as the weekly chart, because they give you a better picture on the direction of the company long-term. But first, let's look at the daily here. And you can see here, since August 23rd, this stock was as high as $69.75. And you see it ran down pretty hard, actually, from 69 all the way to 56, and then lower to $53.22. I actually had an alert at $53, where if it hit $53, I was gonna buy a lot more, because you can see here during the COVID pandemic recession in March of last year, it got as low as $45. So I wasn't expecting it to go that low, because obviously the pandemic was like one in a lifetime type of thing. But I was expecting at least to go halfway, and it got there pretty close. It got to $53.22. So I didn't get shares this low, got it actually a little higher, as you saw. But the reason why this stock dropped from $69.75 all the way back down is, if you look at the monthly chart, there was support in that area. So you can see here, $69 over here in May of 2015. It got as high as $70.54 in July of 2015. And then it pushed down, and it dropped here all the way down in August of 2015. But then it eventually got past that $70 mark and got as high as $77. So this is past resistance. And then you can see here, it dropped in 2016. And then in 2017 or beginning of 2018, it got back to $70, and look what happened. It dropped again. So this $70 is strong resistance. This is where a lot of sellers are coming in and selling this stock at around $70. And you can see here also in 2019, it got as high as $68.34. So that $70 range right there, the $70 range is strong resistance. And you can see it happened again. It got as high as $69.75. And look what happened. Close to 70, boom, dropped, right? So when that happens is great buying opportunities. You don't want to buy stock at resistance here at $70. I wouldn't want to buy this stock at $70 because it's strong resistance. So you buy it at around $68, $69. There's a high likelihood that it's going to drop, and you're going to be already in the negative when you just bought it, right? So what we try to find here is where there's support to purchase shares. This is why I did around the $53, and that's why I got in at, as you can see here again, I got in at $58. And right now I'm up because it has a nice run up since I had that, and I have a lot more shares. You can see here, if we go to this here, you can see I have about 180 shares, and I'm up roughly $500. And that's not including the dividends that I've received during this time period since I've owned this stock around the $60 range. So I was able to lower my cost basis purchasing more shares. But overall, you can see here, support. This was resistant around the $54, $55. This was resistance, now becomes support. You can see it bounce here, it's bouncing here, here, bounces here, and now it bounces here in around $53. So right now, you could still purchase shares of this company, around $62, $61, and possibly run it up to $70. And it may even jump past $70. You can see here it passed it to $77. So you may want to take some shares off at $70, or just continue holding it and just ride the wave. Take it to 70. Hopefully it drops back down to 50, where we could purchase more shares, and then eventually in the long term goes higher. And I'll show you why that I think this stock is going to go much higher in the long term. Morningstar, you can see here Morningstar gives it a 4-star rating, which is a buy recommendation. It has a fair value price around 68, so that around that $70 mark. It has a wide economic moat, and some other things that I like here. You see debt to equity ratio is pretty good at 1.23. I like to see at 1.5 and lower. Interest coverage is not good. This is because they've used debt to purchase some acquisitions the past few years. But those acquisitions have been tremendous. If you look here, in 2018, the company made $22 billion in revenue. And in 2020, they made $42 billion in revenue. So almost double the revenue in 2 years. Trailing 12 months is at $45 billion. So revenues continue to grow. So this is one of the reasons why I like this. With revenue, net income grows as well. So if we look here at valuation, right over here, you can see currently price to sell ratio at 3 versus almost a 4 5-year average. Price to cash flow at 8.8 versus a 15 or 16 price to cash flow. And the price to book ratio is low as well, 3.6 versus a 5.3 5-year average. So those are good indicators that the company is undervalued. Now, if we look at fast graph, you can see here earnings are expected to be $7.51 for 2021. And it has a 70% increase compared to 2020, which was a 37% increase compared to 2019. So you can see this company has been growing earnings very nicely throughout the year. And this fast graph chart shows you why it's so important to purchase stock undervalued. Because even though the company was growing earnings, you can see here, if I take out the price, since 2015 or even 2014, it was growing, 2%, and then it started to really pick up. It's been growing. This is what the company is doing: growing earnings, it's getting better, getting better. But the price has done absolutely nothing. If you were to buy, say over here, at $63 in 2014 to where it is now, 61, you only had a total annual rate of return of 2.1%. And most of that came from dividends because the market value will be under your $10,000 investment. This is if at that time you invested $10,000, it'll be under the value. However, the dividends will make it up, and your total return will be $11,000, but only 2.1% compounded annually, which is not great at all. We don't want that. We want to make at the very minimum 10% annually in every company we invest in. So this is why it's so important to check the valuation of a company to find, great company. Even here, it's a great company, but the valuation doesn't make sense. So it's expensive. And when you pay for a company that's expensive, your potential return for the next 5 years, 10 years is going to be very low. As you can see here. So basically for around 5-6 years, this company hasn't done anything for anyone who's been buying shares at this price. Now, eventually, if say you were bought it here at 65, hopefully it goes up here, the price takes it up here, and then you have a nice, decent 9% return. But who knows, right? I'd rather buy a company undervalued, even if it takes a few years for the market to see the valuation of the company and determine, hey, this is undervalued, company's earnings continue to grow, revenue is growing, everything is growing, and it's cheap at only, right now at 8.24 blended PE. This stock needs to be around a 15 PE. So this stock should be around $100, $118, $120 worth per share. And another thing that I really like is, as you remember, the 10% dividend increase. This company, Bristol Myers Squibb, has free cash flow, which is out of this world. You can see here, free cash flow has been growing tremendously. 117% in 2019, 22% in 2020, 15% expected for 2021. 19% next year, 13%. So in double-digit rate. So what this does is that it increases the dividend potential because the company free cash flow very well covers the dividend. So this gives the company more room to continue to grow the dividend at a double-digit 10%, 15%, 12% growth every year. So not only are you having that double-digit growth, you have a decent yield at 3.5% currently. And so overall, I like that a lot. The free cash flow is tremendous. So if we go back to adjusted operating earnings, you can see here, earnings expected to be growing 70% year over year for 2021, and then 5% and 3% for 2022 and 2023. And we look at the forecasting, you can see here, analysts are expecting continued growth long term. You can see here continued growth at around around 4% growth. But because of the valuation is so cheap, if it revert back to a 15 PE, you can see here you average around 17% annually compounded. So that's tremendous rate of return while you collect the dividend. And even if it just stays flat here, it just goes back and forth, 70, 60, 70, 60, 70, 60. You're gonna be collecting great dividends and a growing dividend at a double-digit rate. So this is why I like Bristol Myers Squibb, and you can see I made a video before in December 10th at $60.23, and at that point it went up as close to $70 as you saw, right? So that would have been a nice little profit there if you took it at 70. But I personally don't sell it at resistance. What I'm doing is I just buy it, hold it, and if it goes to resistance and drops down, I buy more shares. And that's what the cycle I've been doing, because eventually I want to get 500 shares of this company, around the $60, $55 range. If not, with the 180 shares, I'm happy with it now. I don't plan to add more shares currently. So the 180 shares, I'm very happy with that positions. It's profitable. Just been collecting a raising dividend throughout the years with that. So overall, Bristol Myers Squibb, solid company. It's a company I think you guys should look at. I've done some videos of this company, as you can see here, and overall solid company, and it's undervalued and a great buying point at this price point. So thank you for watching. If you're new to the channel, make sure to hit that subscribe button, like this video if you enjoyed it, and I'll see you guys in the next one.